Hello, agents. Hello, everyone. Today, I'm going to be really quick discussing some very general differences between taxable interest and tax-deferred interest and how they're earned. And by the way, the 10-year Treasury at 3.46 today, really high. And we've seen those annuity rates respond pretty quickly too, with 4% interest rates guaranteed and immediate annuities going up as well. But back to this example here. So what I did is I took $100,000 earning at 2%, and one is pay as you go. So, taxable, something you'd get a 1099 for every year at the end of the year, such as a CD at the bank, savings accounts, anything like taxable interest at the end of the year. And then we also have the pay later bucket here, and that is tax deferred. So let's take a look. So in the first year, if you have 2% interest on $100,000, you earn $2,000. And a 20% tax bracket, we're going to assume, is a $400 in tax. So once you pay as you go, you have now paid that $400 in tax. So your $102,000 is now worth $101,600. And we just continue this down the road, and you pay the taxes here every year. And I just did a 5-year plan here. So at the end, you can see that the difference, if I get out of the way, there, I'll pull myself out of the way here, boom. And you can see the difference there. So at the end of the, let's look at the taxable too. So there's no interest on the tax deferred. So, and as you see at the end of the 5th year is when we're going to pay the taxes. And in this case, the $20,000, instead of pay as you go, you're going to pay it at the end. So you made $10,408 at taxes of 20% is $2,082. So at the end of the day, the pay later bucket with the same interest rate, same tax bracket and all that is going to wind up at $108,326, whereas the taxable pay as you go bucket, $108,261. Not a big difference there, but still a difference. And it shows where the compounding, and there's no extra money or anything different. It's just the time value of that compounding and the interest earning interest. It's that simple. So as you see, you actually paid more taxes, $2,082 on the deferred annuity, on the deferred tax, and you paid $2,065 on the pay as you go. However, you earned less on the pay as you go, $10,326 compared to $10,408. So that's the basic idea. Interest earns interest, and this is at a 2% rate. As the rates go up, as you get 4%, and oftentimes the taxable products are not as high interest rate as the tax deferred products, but just to do an apples to apples comparison. But really right now, if you look at CDs at the bank, you're maybe getting 1 or so, whereas your annuities are up to 4. So you got 3 times earnings plus your deferral there and all that good stuff. Yeah, great. So let's take a look at where you can get some information on annuity rates. If you go to our website, annuityexperts.com, and at the top, you'll see this MIGA rate right up here, and you go ahead and click on that MIGA rate, and I'll bring you to this page, and you'll see all the terms there. And you request information, I'll give you some basics. The sweet spots right now are between the 2 and 6 year range. Really, people feel it's not a good idea to lock up longer than that. Anyway, that is the end of my presentation regarding taxable and tax deferred earnings. I hope you found that enjoyable. If you understand, next we'll get into some like the 10% excise tax, do a video on that. But if you have any questions or want more information, right here is my number. Give me a call. My phone's not ringing. It just rang, but it needs to ring more. And follow me on LinkedIn and YouTube. I always do the most updates on LinkedIn. It's just the easiest platform to work with. Great. And I also put these videos out on Instagram after a day or so. So thanks for watching. I hope you all have a great week, and take care. Bye-bye. Thanks.